Climbing home prices and the shortage of inventory are making it challenging to realize the American dream. People have been delaying their goals to purchase homes because it's just not feasible. And as a result, Fannie Mae lowered the down payment requirement on multifamily homes from 15 to 25% all the way down to 5%. This provides a new opportunity to not only become a homeowner, but it's also a real estate investor that you can become, aka house hacking. Now in this video, I'm going to discuss why you should purchase multifamily property, how to purchase, and how to find a good investment property that suits your needs. Now buying multifamily property is a great way to get into your first home. With the right financing and deal, they can be a sound investment. The tenants may cover all your expenses and you can recognize appreciation on top of the mailbox revenue. It's also a solid way to build wealth through equity. And once you accrue enough equity, you can then cash out, refinance, purchase another multifamily, or go buy the single family residence that you always wanted. And this could be a great gateway to financial freedom. Now, some of you would rather be renters, and that's okay. It just means that there's always going to be a demand for rental properties. There's a saying, you're already paying a mortgage. Whose mortgage you pay is totally up to you. Okay, this all sounds great, but how do you do it? Well, you ask good questions on YouTube. The process is very similar to single family homes in that you'll need to get pre-approved for a loan and place an offer on a home. Now, when it comes to financing, the deals are a little trickier to understand. For one, the amount you can borrow differs between single family residence and multifamily. With the new changes, the maximum loan amount allowed for 2 to 4 unit properties is tiered, but it goes all the way up to about 2.2 million. This ensures that larger and more expensive properties can be purchased with flexibility. One huge change is that Fannie Mae has eliminated the self-sufficiency test, making it easier for buyers to get pre-approved. The self-sufficiency test requires that rental income from a 3 or 4 unit property would be able to cover the property's expenses, including the housing payment. This test ensures that the property generates enough rent to be a sound investment and that you can make the mortgage payment and whatever other obligations that you have. Now, to pass the self-sufficiency test, the net rental income for the property must be greater or equal to the PITI, or principal, interest, taxes, and insurance. Net rental income is 75% of the gross rental income, with gross rental income the total amount of rent generated by all the units, including the one you live in. Now, to calculate the monthly net rental income, lenders use what's called a property appraiser's opinion of fair market rent from all the units, including yours. Then they subtract 25% of the vacancy factor provided by the appraiser, whichever is the greater. Now, that's a lot of lender speak, but what does this really all mean for you? It means that you're able to purchase a 2 to 4 unit property, which are typically higher in price, with a lower down payment and the ability to create residual income. I know all of this sounds good, but how do you find a good investment home to house hack? Look for prime locations, thriving neighborhood areas of growth potential, revitalized areas that are being gentrified. If you start to see yoga studios, coffee shops, or new rapid transit, those are areas to consider. Also, you're gonna need to understand and know things like capitalization rate, net operating income, property income, total expenses, rate of return, vacancy rate, and cash flow. Whew, that's a lot, but I'm gonna walk you through some of that stuff. Now, capitalization rate is equal to the net operating income divided by the purchase price. Now, capitalization rate is also known as the cap rate, and it determines the return of the property aside from the financing costs. Essentially, it's an estimate of how much you'll make on the investment. It's commonly between 4 and 10%, but you want to make sure it's beating what you could get in the stock market. Now, the average yearly return of the S&P 500 over the last 100 years has been 10.5%. That's as of December 2023. Now, you need to take that with a grain of salt because there are economic factors that none of us can control. But if you find a great property, it could get better returns over the long run. Now, the NOI number that I talked about stands for net operating income. It's the income minus your expenses, and it doesn't include what they call the debt service, which usually includes your mortgage payment. The reason for this is that the NOI simply determines how much the property produces minus your financing. In other words, is the project or the property profitable? Property income equals the gross income, which includes all the property's income. That's tenant rent payments, parking fees, utility, if you have a laundry facility on site where you charge the tenants, vending machines, the whole 9 yards, any place that you essentially generate revenue from. Expenses include insurance, taxes, mortgage insurance, utilities, property management fees, any repairs that you need to make, and basically anything that's costing you money. Cash flow, that's one of the things that you're really gonna wanna know of, is your income minus your expenses. Essentially, how much money you put in your pocket at the end of the month. Now, your rate of return, this is a little bit tricky. That's your cash flow divided by your investment costs. This gives you a good idea of how well your investment property is going to perform. On average, you want to see somewhere between 8% and 12%, but I've seen some investors shoot for 15% or even higher. Now, this ratio is also known as return on investment, ROI, or cash on cash return. So for example, if your annual cash flow is $24,000 and you invested $500,000, your rate of return would be 4.8%. That's a bit on the low side. So in this scenario, you either have to lower your investment costs, lower your expenses, or raise your rent. Some or all of those could be quite challenging. However, take that same $500,000 investment, but have an annual cash flow of $40,000. Now you have a rate of return of 8%. That's pretty good. Vacancy rate is something that's a little bit tricky. Now, this is the percentage of units in a rental property that are occupied, and it's calculated by taking the number of vacant units and then multiplying that number by 100. Then you're gonna divide that number by the total number of units. So in order for you to use this effectively, you're gonna have to compare rates to similar properties. For instance, you can't compare a 4-unit building to a commercial apartment complex with 100 units. Now, you're probably wondering, where do I find these rates? Well, the US Census Bureau compiles its residential vacancy data in a quarterly report, and you can get that information there or from your trusted real estate professional. High vacancy rates indicate that a property is not renting well, while on the other hand, low vacancy rates can point to strong rental sales. But again, you're gonna have to compare similar property types in order to make the proper analysis. So if you have a 4-unit building and one of those units is not occupied, it's vacant, then your vacancy rate is 25%. But if you take a 100-unit complex and only 10 of those units are vacant, then that vacancy rate is 10%. In this scenario, you would think that the 4-unit property is a laggard, it's a dog, because it has a 25% vacancy rate. No, it's because there's kind of strength in numbers, I would say. So you're comparing 4 units to 100 units. Obviously, the more units you have a little bit leeway in terms of vacancy. Whereas when you only have 4 units, one of them being vacant is going to affect your vacancy rate. So again, you have to compare apples to apples to make this a comparative analysis that's worth its weight in gold, so that you can't compare one type of property versus another type of property and assume that the rate should be equal, because all things being considered, they're not going to be equal depending on the number of units that the building has. There are some potential issues with purchasing multifamily. Now, depending on what you're trying to do, AKA if you're trying to house hack, it's usually because you have limited capital and you don't have a lot of money to put down on a house, and you actually don't mind becoming a landlord. If so, it might be best for you to purchase multifamily first. But wanting to be a landlord and actually being one are not the same. There are a lot of tenant landlord laws that vary from state to state, so you're gonna need to be aware of what those laws are. So for example, when COVID hit and many people stopped paying rent, there were laws in place that stated that landlords couldn't evict for non-payment of rent. And if you were one of those landlords, people didn't pay you rent, but your mortgage company still said, pony up, we want our money. Also, you're gonna have to qualify at the higher loan limits, but that 75% rental income that's used to qualify you is going to help. You also gotta be aware that FHA has its own set of guidelines to qualify. Now, I won't get into the ins and outs of what you'll need to do to qualify. I'll probably do another video on that, but you're gonna wanna talk to a mortgage professional to walk you through what you need to do. And if you need a lender, if you need that referral, just leave me a comment and I'll assist you with that as well. Now, this was part 3 of a 3-part series on home buying tips. And if you haven't seen parts 1 and parts 2, you're gonna wanna go watch those right now, because they're gonna show you how to qualify for a mortgage and where there's available money to help you with your home purchase in terms of down payment assistance. So again, if you haven't seen parts 1 and parts 2, you're gonna wanna watch those right now.